Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, as you can tell, I am currently traveling, so I apologize in advance for any audio issues or if there's any background noise. With that being said, in today's video, we're going to be going over my top 5 watch list stock and what it would take for me to buy into these businesses. I think a couple of them you could probably predict if you are a regular viewer of the channel, and I'm hoping I could catch you off guard with at least one of them here. But without further ado, quick shout out to the user from our Discord server who actually recommended to do this video. Harry Wilson, can you talk about the top 5 companies on your watch list that you would start a position in if you see a dip? And so without further ado, the first stock on the watch list that I'm actively researching, if you've been over on the Twitter, I did a video on them recently. I'm very much interested in potentially opening a position in the business. I think it trades at a very attractive valuation, but I'm a bit hesitant because of the competitive pressures of the business. It is in fact going to be Adobe, and they are set to actually report their earnings tomorrow, I believe. So we'll see. But yeah, I kind of gave you an overview on what it is I'm looking for with this business. I think at the moment, if you haven't really kept up with the story of Adobe, obviously they are facing competitive pressures from a variety of different point solutions, is what they're called. Namely, we have Figma and Canva. There's of course the suite of tools from Affinity. There's obviously the LLMs that are now able to do pretty minimalistic levels of creative design. And then additionally, there's CapCut as well, which this is the TikTok video and photo editor. Now this data is from, I think, halfway through 2024, where it says that they were doing roughly $125 million of ARR. Oh, and it says that that's so far until that year. So they've made $125 million year to date in 2024. I would assume this is approaching, like the $700 million a year mark. Very cheap plans of about $10 per month. And they're really targeting that lower end consumer of TikTok video editors, Instagram Reels and stuff like that. And it's gotten very wide adoption. On the free tier, in terms of monthly active users, they've already beat out Adobe and Canva and everybody. They've got, again, this is like halfway through 2024. They had 300 million monthly active users. So CapCut by itself is just a juggernaut within the industry. And then you layer on the fact that, they're facing competitive pressures and question marks around the AI fears and stuff like that. Within the next 5 to 10 years, is there even really going to be a need for Adobe products? It just seems like another sort of death by a million cuts scenario. But despite all that, if you simply just look at the numbers, this is kind of reminiscent of Google search, where, Google search, despite all the threats from ChatGPT and LLMs and all these different things that are kind of quote unquote affecting the business and are risks to the business, Google search was also growing 10% revenues for a very long time post ChatGPT launch. The same could be said for the revenues of Adobe over the past 2-3 years. They've consistently been able to grow their revenues at 10% or higher. I think we've had literally one quarter in Q3 of 2023 where it dipped by 0.1% below a double-digit rate, meaningless. And then at the same time, the valuation has gotten so cheap. I think it's at like a forward PE of 16 times. Yeah, forward PE of 16 times is the cheapest the business has been. We only have a decade's worth of data here, but I would assume if you extend this chart out to the past 20, 30 years, the only scenario where the company trades at this cheap of a multiple is probably the 2008 crash. Even during the COVID-19 crash, the business didn't trade at this cheap of valuations, right? So it's effectively the cheapest the business has ever been. They're still growing revenues at a double-digit rate. You layer on the fact that they're buying back, I think, roughly 7.5% of their shares outstanding, just given the strong free cash flow generation of the business. They're dipping into the bank account a little bit. They're kind of doing more buybacks than they have free cash flow. So, take that with a grain of salt, add in stock-based comp. They're still able to probably reduce shares outstanding by about 5% annually, assuming the valuation stays flat at the current valuation. So overall, like the setup of the business, fundamentally speaking, is fantastic. If we didn't have the bad narrative with the company, I think this would be a fantastic business to kind of look into. Obviously, we are all very familiar with unbelievable margins that this business has. 90% gross margins, coming up on 40% operating margins. I don't need to tell you that this is a good business. It's been a fantastic business. But again, those question marks around competitive pressures is kind of what I need to figure out a little bit more. Actually, on the plane ride here, I was kind of looking into their Adobe Summit, where they kind of break down the different type of users they've had. I would just absolutely love it if the company would come out and like really communicate to shareholders and give specific percentages of okay, 30% of our user base is small to medium-sized businesses. 60% of them is like what we deem professionals who are in who have accounts of like 10 seats or higher. Similar to actually how Monday.com, which is another company on my watch list, but like if you look at Monday.com, they don't deliberately break it out the way that I said. Oh no, actually it seems like they do. But you see, like they say customers with 10 plus users. I would absolutely love if Adobe would give us a breakdown of customers with under 5 users, customers with 10 plus users, customers with 50 plus users, right? And like you can see, and based off the available data, that okay, realistically, the customers with, 100 plus users, they're probably not going to churn. They're probably professional. CapCut isn't going to be a realistic vendor for them. They're probably just going to continue paying their Adobe subscription. I would like to see a little bit more granularity with their numbers. And that's just KPIs that they don't report. They don't have that. They don't give you that information on the Adobe Summit. There's just no mention of it anywhere that I've personally looked at within the company's materials. Maybe I'm just stupid and I'm missing these numbers, but that's something that I would appreciate if the company were to kind of communicate. Moving on, Monday.com is the second business I'm looking into. And this one's a bit of a weird one because in the whole, and I also did a video on these guys. So feel free to, I'll put both the Adobe and the Monday video at the end of this video if you want to watch either one afterwards. This has just been a very solid business. They've grown their top line consistently at like a 30%-ish CAGR for a very, very long time. They're starting to kind of ramp on profitability. And as a result of that, you're seeing that the top line growth has started to kind of deaccelerate. They gave a worse than expected guidance. I think they said that their revenue for the full year or maybe the next couple quarters is going to be like in the low 20s area. And that's what really drove the stock down. I think the stock dropped roughly 30% in the same day. Really, the reason I'm interested in this is because these software companies that, despite them being in crowded market, but as they kind of turn the corner on profitability, if they're able to kind of balance, growth and profitability, still being able to grow north of 20% while they ramp those margins, they tend to be pretty good businesses to own within those couple of years. Case in point would be something like Salesforce. I think ServiceNow is kind of going through it. Workday is kind of going through it. I know all of these software stocks are down at the moment, but there's been good alpha that has been generated during these periods. My big issue with this is that at the moment, and my research doesn't run super deep with this company, I just don't see this company having that good of a moat. All software companies benefit from some switching costs. So that's kind of like a default playing field for all software companies when you're comparing them to one another. I really don't see, particularly with Monday.com, what it is that makes them so special as opposed to any other project management tool that's out there. So again, this is something that's kind of more distant on the watch list. I'm not particularly targeting like a specific valuation or anything like that. It's just more a question of me doing more research and kind of learning about the business, seeing if there's any like long-term moats that the business can possibly benefit from. But I mean, again, fundamentally speaking, valuation for especially a SaaS business, 7-ish times EV to sales is not that bad. That's roughly where Salesforce trades at in a bull market. And then at the same time, you have a top line that's growing north of 20%. You have that margin expansion coming through. So there's a lot of things to like here. But then again, competitively speaking, what's the moat there long term? Now, next up, because we have been talking about companies that from a moat side or from a competitive side, I'm not too interested in. This one, I'm super interested in. I would absolutely love to open a position, but I'm going to be a little bit more patient and wait for a cheaper valuation. This is a company that you probably have not heard of, and I haven't talked about it publicly much. I'm going to be doing a deep dive on it because I think this company is alongside the S&P Global, Moody's, Fair Isaac, you name it, those super wide moat businesses. This company should be spoken about in the same sentence. It is one of the widest moat companies on earth. Safran, ladies and gentlemen. This is, alongside GE Aerospace, one of only 2 companies on earth that is able to make the narrow body engines for companies like Airbus and Boeing. That's sort of their main business. They do have other lines of business and that sort of stuff, but essentially they just make jet engines. Pretty boring industrial business, and yet it has one of the widest moats in the world. I'm starting to really look into these industrial companies that make parts for airlines. There's a lot of things to like with these companies, and I'm going to save it more for a detailed deep dive into Safran, GE, Honeywell is another company that comes to mind. TransDigm, which I think some of you will have heard of this company. TransDigm, also a super wide moat business that makes aircraft components. But more specifically with Safran, the reason why I really love this business is because there's like a secular growth with airlines, or I should say with travel and airplanes being built and stuff like that, where in general, you should see the growth of that be GDP plus a couple percent. And then more specifically, the subcategory of that industry that Safran is focused on, the narrow body airplanes, which essentially, by the way, just refers to like airplanes with only one aisle as opposed to 2 aisles. It's more for shorter distance flights, not necessarily transatlantic, like not necessarily North America to Europe, more like Europe to somewhere else in Europe, or Europe to like somewhere in Asia and stuff like that, right? And so that part of the industry is growing a little bit faster. And then to layer on a little bit more onto that, they have backlog that extends past like 2031. And there's a lot of duality with this business and something like ASML, where same thing with ASML, like, you have like your DUV business, and then you have your EUV business, which is supposed to grow a little bit faster, and like the backlog extends multiple years out. And again, similar to an ASML, but actually I would say to a further extent, ASML makes a good portion of their revenues, and we could actually show this to you on Fiscal AI here. They make a good portion of their revenues through servicing and maintenance of these machines after they've been sold. For ASML in particular, it accounts for only 24% of revenues. It's actually been going down as a percentage of total revenues over the past decade. With Safran, on the other hand, and unfortunately they don't break this out directly, but it's kind of estimated that about 70% of revenues is actually made through the servicing, maintenance, and repairs of these engines after they've been sold. And the only company that has the technological know-how to be able to service and maintain and meets the regulatory restrictions of over 200 different countries is the company that is selling you the engines to begin with. So they sell them these engines for essentially 0% gross margin. They lose money on the engines, and they make unbelievably high margin revenues back in terms of the maintenance and the servicing, which is super predictable. There's certain deal structures that they put in place where it's like almost subscription like. The airline, which again, like Boeing is their customer, but the airline actually ends up paying them essentially a subscription fee to have them on call to come in and fix the engine if it ever goes down. So they make, technically less revenues on that as opposed to just charging per engine failure or whatever goes wrong with the engine. But the predictability of the revenues is a very worthwhile trade-off when they do that sort of deal structure as opposed to per engine fix. So just so many things to like with this business, more in terms of the valuation. I think this is a really great bet to kind of diversify away, because obviously, if you guys are familiar with my portfolio, it's very tech heavy. I mean, basically every business in here is a tech company to some extent. Even something like Pfizer, which is only 5% of the portfolio, even that is kind of like fintech sort of business. It is in the financials, but at the same time, they have a lot of technology on their back end and stuff like that. So something like this as a core position, call it 10, 15, 20%, is something I'd be super interested in the call it next year or so for me to kind of build out the position. And it's really good because it diversifies away from tech. I have a business that doesn't trade on the same sort of catalyst that some of these tech companies trade on. Overall, it's just a good diversification point for me personally. But yeah, more in terms of the valuation, where would I consider buying into this business? The valuation's a bit weird because, and actually I could probably just layer on operating margins here, but currently trades at 25 times operating income, which isn't cheap for a company that is, best case scenario, growing in the mid-teens-ish. So I don't love that. And, there's a cyclicality risk to it and stuff like that. But at the same time, it's not like some eye-watering valuation. I think as it slides closer to like 20 times EV to EBIT, it starts to look really attractive for the long term. That's roughly their median over the past decade as well, 21 times EV to EBIT. I think it's a pretty good place to, for me personally, start a position. You really can't go wrong with this level of quality for a business. The predictability of revenues and everything like that, it's just such a solid bet. And then at the same time, like, I think just because this company is French, it trades at a discount. If you look at GE Aerospace, for example, which is like literally their counterpart, they're partnered up through a joint program called CFM. If you look at GE Aerospace, which is like effectively their American counterpart, they trade at 30 times EV to EBIT. And like, realistically, I'm sure GE has like, I haven't looked into GE too much, but I'm sure they have a little bit more diversified revenues, or they have their hands in multiple different things and stuff like that. But the valuation gap between these two is rather stark. In the Visa Mastercard comparison between these two, this Safran is the Mastercard, which probably grows faster and trades at a discount in this case. Make that make sense? I don't know. But yeah, anyways, this is, I'm going to be doing a deep dive on this. It's super, super interesting business. Moving on. I believe this is the fourth company on our list here. I did an hour-long deep dive on them. In the video, you could see me looking at it at $90 a share. This company has just skyrocketed since I started looking into it. It's the one that got away from me. Shopify, one of the greatest businesses on earth, coincidentally also Canadian. So, I mean, I got that home turf bias a little bit, but it's such an incredible business. I really do recommend you watch that deep dive that I did on them. They have so much secular growth for the next 2 decades with e-commerce, and now they're pushing to be a little bit more upmarket into enterprise. There's just so many things to like about this company. They have so much optionality with being able to provide a variety of different services to merchants, variety of different softwares and solutions, and start doing payments in-house. It's just such an amazing business. unfortunately, the valuation is very appropriate for the quality of the business. Trading at 18 times sales is nothing to cough at. It's excluding, the 2020 and 2021 euphoria. This is on the higher end of where it trades at typically. And back here in 2017-18, they were growing significantly faster. Of course, now they're a little bit more profitable. With this, in an ideal world, we go into a bear market and I see this under 10 times sales, which, by the way, when I did that deep dive, the company was trading at about 10 times sales. So I should have just paid the little bit of a premium and opened my position. But yeah, at the moment, this is on the watch list. I really love the business. I've done so much research on it, and I really feel like I have a good grounded sense of the business and the future of it. It's just the valuation's a bit of a unfortunate circumstance for me personally. I would like to see it in the low teens EBITDA sales area. I think that's where it kind of starts to get interesting again. At the same time, you do have a company accelerating revenue growth to north of 30%. So it remains to be seen if we get that sort of a dip anytime soon. But yeah, if I were to take a guess, this is a name that is firmly on the watch list for a while because I don't see this company having a dip anytime soon. Now, lastly, I'm going to kind of put two companies in here at the same time. Obviously, the video is top 5, but it's kind of whichever one of these companies has the better valuation to growth at the time that I'm to buy them. And it's going to be Adyen and Mastercard. Now, a bit of a brief history with these two. I've been researching Adyen, I shouldn't say researching, but it's been on the watch list for over a year. It's such an incredible business. And to those of you who don't know what the company does, it's essentially a merchant acquirer. So similar to let's just say you're a video editor and you get paid internationally. Your boss probably pays you through a PayPal account or something like that. And so you get paid, I don't know, $1,000 a week into your PayPal account, and then you distribute it over to your local bank account. Adyen kind of serves the same purpose, but for enterprise companies. So if you're a McDonald's, if you're Uber, for example, Uber is an Adyen customer in Europe. Obviously, Uber's actual bank is within the US, but to kind of consolidate and gather their payments in a local European bank before they distribute it over to their US bank, Adyen serves as a pseudo PayPal account to receive all the payments into an Adyen account inside of Europe, and then they send it over to their American bank. And it's a very simplistic analogy of what Adyen actually does behind the scenes. And I'm sure, I think we have one Adyen employee that regularly watches the video. So I'm sorry if I kind of butchered what your company does, but it's a very powerful business because Adyen is the industry leader in terms of authorization rate. So whenever you have Adyen as your checkout page, and this is kind of literally what it looks like, similar to a Stripe, by the way. Adyen is a direct competitor of Stripe. But whenever Adyen is your checkout page, your authorization rates, which just means the percentage of your transactions that go through, are higher than any other competitor. Now, there's no actual material or concrete numbers that is shared by anybody in the industry of Adyen's a 98% authorization rate and so-and-so competitor is a 90. But repeatedly, there's been trustworthy sources that state that Adyen has by far the highest authorization rates, and that's kind of the moat. So their take rate on that is a little bit higher. So they might take 20 basis points out of the transactions as opposed to let's just use PayPal, for example. So PayPal owns Braintree. Braintree might take 10 basis points out of the transaction. So Adyen is twice as expensive as Braintree, but then it's kind of irrelevant because if 98% of your transactions go through as opposed to 90% with Braintree, it doesn't matter how much Adyen is charging at the end of the day because you're having more of your transactions go through. And so the cost kind of becomes irrelevant in that. And that's the power of Adyen and the business that Adyen has built. And then obviously, payments is pretty mission critical portion of any business's existence. So it's not as simple as once you get integrated with Adyen, you don't just switch providers in an instance. Notice there's a lot of back-end development and switching costs that are incorporated within the adoption of a payment service provider such as Adyen. So that's the overview on Adyen. Mastercard, I think you guys, everybody knows who Mastercard is and what they do. They're probably a customer of Mastercard, kind of, and they're just a payment network, right? And I used to own the stock and I sold it for Pfizer roughly 4-ish months ago, which, I understand why there's a bit of question marks around that. But as I highlighted in previous videos and previous tweets, they're both in the payments industry. I just want one sort of payments company within my portfolio as I run a pretty concentrated portfolio of stocks. And I think there was an asymmetric upside to Pfizer at that point in time. I think, it trades at very cheap PE multiple, or EBIT, whatever you want to take in. Trades at the moment, it trades at 12. I think at the time I bought it, it was a 14, 15 PE. There's a really good chance that this company re-rates in the call it next year or two. Call me a trader, call me whatever. It's a 5% position in the portfolio. Everything else in the portfolio I hold for the long term. I thought there was just some easy opportunity to kind of make, call it 50%-ish on my money in a very short amount of time. And then I wouldn't be opposed to buying back into an Adyen or excuse me, buying back into Mastercard in the future, right? That door is always open. And so this leads me to my final point of between Adyen and Mastercard at the point when Pfizer re-rates, which, of course, no guarantee to it, but I think at some point in the future, once we kind of get past the headwinds with that business, it's going to re-rate to a higher valuation and I'll be able to sell out at a massive gain. Depending on the valuation to growth difference between the two of these companies, I'll probably choose one or the other. I'm personally in favor of buying into Adyen. It trades at a very slight premium to MasterCard. And I know they're not the same business, but again, it's in the broader payment ecosystem. But with Adyen, for paying up roughly 10% in valuation, you're getting more than double the growth. Adyen's revenue growth in the past 12 months has been 33%, while MasterCard has been only 15%. And I know, revenue growth isn't everything at the end of the day, but it's the primary driver of earnings growth and everything that flows down beyond that point. And for those of you who are kind of giving question marks around, how sustainable is that revenue growth? I'd like to point you to one of the greatest quotes I've ever heard across any conference call ever, which is 80% of incremental growth comes from existing clients. I'm going to read that one more time. 80% of incremental growth for Adyen comes from their current client base, which essentially just means the average account value or the average revenue per customer that Adyen has is consistently able to climb at incredible rates. They don't need to go out and get new customers. They don't need that many new customers, is what I'm trying to say. So the customers that they've already acquired, they're able to harvest for like a 20-25% revenue growth, which is just incredible. So it's a very, very fundamentally strong business. And, some of you might laugh at like a 40 PE, call it expensive, whatever. But for the quality of the business, for the unbelievable amounts of growth that it has, the predictability of that growth, it's such a solid bet. Even at today's valuations, I'd just like to kind of wait and see how my Pfizer play goes before I'd make a decision for it. But even today, I think the valuation is more than appropriate. I think it's a company that can compound for a decade plus. But anyways, thank you very much for watching. If you'd like to come join us in the Discord server and hang out with me and 250 other investors, we'd be more than happy to have you. For the price of a coffee, link in the description. You can ask for exclusive videos. You can ask for specific questions. We have a bunch of discussion threads talking about various different stocks. And there's just overall great conversations that we're having over on the Discord server. So by all means, head over there and we'd be happy to have you. Thank you for watching and have a great day.